just really appreciate whenever we have a chance to have some of our local professionals join us, Jeff. And we've been doing this Wise Counsel Live weekly now, really ever since early into COVID. We originally did these discussions just exclusively for clients only as a way to just kind of keep everybody up to date. Things were happening so fast and there was so much going on, but then it was very well received and we thought we'd keep doing them and open it up to anybody who was interested. So we've been recording these discussions now for, I don't know, 4 months, and they're going up on our website. So thank you for being here today. We're going to talk about something that's right in your wheelhouse, and that is how our regular investment accounts, not IRAs, not 401ks, those kinds of accounts, but regular investment accounts, how are they taxed? And, you know, I find that it's one thing to get a 1099-R, which is a 1099 from a retirement distribution, like an IRA or something, but then it's quite another to get a 1099 when it's on a taxable account. And that's really what we're going to spend most of our time on today. Before I share the first visual for our discussion, just tell us a little bit about yourself, your practice, and kind of your ideal client that you serve.
Sure. My name is Jeff Beasley. I've been a CPA here in the Georgetown area for almost 5 years. Worked in tax and accounting, for another probably 4 or 5 years before that. Our ideal client, gosh, we handle anyone from small to large, medium to large business, and everywhere in between. Most of our clients tend to be married with investment accounts, IRAs, a lot of small self-employed individuals, or just regular employed individuals with who get W-2s as opposed to contract labor 1099 work.
Mm-hmm.
That's pretty much our bread and butter. We do have a lot of small businesses, S corporations. We do a lot of partnership returns, as well as estates and trusts that come through. That's pretty much where we stand with our business these days. It's primarily a tax business with some bookkeeping and small payroll stuff.
Okay. Well, very good. Well, thank you for that. I'm going to share a screen real quick and hold on. Am I already sharing a screen? What are you seeing?
I'm seeing the 1099-R.
You are seeing that. Okay. I wasn't sure if I'd selected the correct screen or not. So a 1099-R, just explain real quickly what that is. And then that's not really what we're going to spend a lot of time talking about, but this is pretty much the extent of what you see when you get one of those.
Yes, that's what my clients will definitely bring me when they have a distribution from a taxable account, or even a Roth. We'll get these with Roth accounts that designate that they are not taxable. So any kind of distribution from a retirement account, we'll see one of these forms.
So like on this one, it's pretty straightforward. This looks like somebody took $33,000 probably out of an IRA, and you see federal income tax withheld $6,600. So they withheld apparently 20% for taxes.
Yes.
Pretty straightforward. But then if it was the same person and they happen to have another taxable account, are you seeing the regular one now?
Oh yes, these are quite common. These are the composite 1099s that'll include your interest, your dividends, your capital gains and losses.
Right. So I thought that today we would kind of break those down for folks and explain to them some of what, try to make sense out of this form. And then it's particularly helpful to have you on the discussion because you can explain, all right, well, yeah, okay, I understand there's interest, there's dividends, there's qualified, there's non-qualified dividends, there's short-term capital gains, there's long-term capital gains. There's even some exceptions in there for collectibles and things like that. But the question is, are they all taxed the same? And if not, how do they flow over onto the tax return? Of course, people who do what I do for a living, we have to know enough about those things to be able to try to give people proactive advice. And we're always trying to look for ways to minimize tax burdens as much as possible. But there's a lot of levers you can pull to do that. And, we like to try to make the complex simple. And I don't know about you. You see these so often, but the average person, when they get one of these 1099s, this particular one here is 22 pages long for a
Yeah,
single 1099.
they
So
can be pretty
there's a lot
overwhelming.
going on. There's a lot going on here. So let's just start with the most basic, and that would be just interest income. I think people all relate to, okay, I used to get some interest on my money in the bank, right? Maybe my CDs. Now I'm hardly getting anything on that, but they were pretty used to the idea of getting a 1099 from the bank for just their interest. But brokerage accounts, they can also generate interest, and just speak about that for a second.
Sure, there's a regular interest, there could be tax exempt interest. Uh, there's a bond premiums on tax exempt interest. There's all different kinds of things that may or may not have an implication on whether or not they have tax. So interest income, of course, is always going to be taxable, but the tax exempt interest isn't. It does have other effects that could possibly cause issues with
Mhm.
adding back to modified adjusted gross income and things like that, but that can get a little more technical.
Yeah. Well, so for the most part, like on this one here, can you see do I need to zoom in some, or can you see this
Nope,
okay?
that's perfect.
Okay. So like on item number 11, it says exempt interest dividends.
Yeah.
So in this case, $100, what would that be telling you on the return? Where would that go?
Well, it goes in this different schedule in the tax return on my tax software,
Mhm.
and it may or may not have a bearing on reducing the amount of taxable dividends.
Okay.
So it all goes into a calculation that we use to decide that.
Okay.
Exempt interest dividends, uh, sorry, yeah, they can reduce the amount of taxable dividends.
Okay.
And the bond specified private activity bond interest dividends, that's mainly for AMT calculations,
Mhm.
which we're not seeing a lot of these days.
Okay. So if this particular individual had just some regular old fashioned interest income on a money market account, or maybe they own some CDs in their account, um, it would just show up on here and as additional income that would be taxable interest, right, for that year, and just stacked on top of all their other ordinary income.
Ordinary income, yes, sir.
Okay. Well, in this particular example, we're looking at, if you look up at 1A and 1B, we've got another interesting animal here. Ordinary dividends is the bigger of the two numbers, and qualified dividends. Speak to what those are and kind of the difference in taxation on those, and maybe a little bit about what does that even mean?
Sure. Now, what makes a qualified dividend is how long you've held on to that stock that issued the dividend, when the dividend was awarded, as opposed to how long you held the stock. So there's some issues in regards to what counts as a qualified dividend, but how it really matters is that it can be taxed at a lower rate than an ordinary dividend, which is taxed at ordinary income rate. So um, that's really kind of the advantage, is it kind of goes into the long-term capital gains taxation rules.
Yeah, and we'll talk a little bit later about the long-term capital gains tables, tax tables, and I believe what I hear you saying is that if it's a qualified dividend, in this case 9,566, aren't those are going to be taxed according to the capital gains tables, right?
That's correct.
But if it's just ordinary dividends, how are those taxed?
Just like your regular interest,
Okay.
ordinary income.
So if I have an option, I would rather have more qualified dividends and less ordinary dividends. I mean,
That's
having taxable income of any kind is a good problem to have. I always tell people,
sure.
but it's a lot better to be taxed at a lower rate if you can make that happen. And so the primary difference between the two is, I believe, holding the security that's paying the dividend. You have to own it for a year or longer, similar to capital gains, right? Treatment.
Yeah, there's quite a few, when it comes to what makes it qualified or not. yeah, a year longer. There's some dates on when it's awarded. I can pull up a little spreadsheet and kind of tell you a little bit more, but actually I don't have that up here.
That's okay.
Yeah, that's pretty much what it is. What makes it qualified out of your dividends? What are qualified and which aren't?
Okay. So is it accurate then in looking at this 1099 that this individual had over 20,000 in dividends, but roughly half of it was taxed as ordinary income and the other half at long-term capital gains rates?
Actually, on this worksheet, I'm seeing total dividends of 10,963, of which 9,566 were qualified.
Okay,
so
good.
Almost all of the dividends in this case are going to be taxed at a lower rate possibly.
Okay. Well, no, that's great clarification. That's why these forms, even if you kind of think you understand the rules, these forms can be confusing.
Sure.
So this would be considered a win for the investor because most of the dividends are by stocks. Presumably, it's mostly stocks that have been owned for longer than a year. Okay. I don't want to get too far down into the weeds. I did notice the 199A dividends down there. Does that ring any bells for you? What's that all about?
So the Trump tax code change that happened in 18 went into effect in 18. That's when we started seeing these Section 199A dividends that are reported on these composite returns. That goes into a calculation for qualified business income deduction. Not all of that 185 will you see as a deduction. It goes into a more complicated calculation in what you can deduct on your return.
Well, if we really want to excite people, maybe one day we'll have you back on and we'll talk about the 199A deduction. Woo, boy, yeah. It's exciting if you get it, but it's not exciting for most people to have to figure out how it works.
Sure.
But yeah, I appreciate that. So let's kind of scroll down a little bit and let's take a look now at the next section, which is important, and that is this capital gains section. And it's basically breaking it down into, I've highlighted here, short-term and long-term, and then the totals. So kind of it help us understand the difference in short-term gains versus long-term gains. And then what are we looking at here as a tax preparer? What are you taking away from this part of the return or the 1099?
So when it comes to short-term versus long-term, a short-term transaction is when you purchase a stock and then sell it within a year or less. So anything long-term is a year or more, and it's taxed at more advantageous tax rates in the qualified dividend capital gains worksheet. Long-term capital gains are taxed sometimes 0, sometimes 15, sometimes 20%, whereas short-term capital gains are taxed always at ordinary tax rates, as ordinary income.
Now, why is it netting them out here and showing the grand total? Because you've got, in this case, you've got a lot of long-term capital gains, about 184,000, and then you've got 46,000 short-term losses. Is there a net that you just take that 138, or do you still report them on the return separately? Just how do they offset each other?
It's important that they would be reported separately because we account for the short-term versus long-term when it comes to possible carryovers. We always take the short-term first because they offset ordinary income. And if you have let's say this is a gain of 138,000. So they would pay tax on that. Most of it was long-term, so that benefits the taxpayer. Let's say it was a loss, a long-term capital loss. They would only be able to offset other capital gains for the year, and you'd only be able to net 3,000 against other income, your ordinary other income, and then you have to carry forward the rest.
And it's in that you can carry it forward. There's no limit on number of years you can carry it forward, right?
No, not at all. It can be carried over forever and ever. And we've seen that with some clients.
Yeah, we still have people that we meet that are still sitting on long-term losses, long-term capital gain losses dating back to 2008, 2009. when the market, crashed. And today of course, now they've been making, most of them have been making good returns, good gains in the years since, and they're using those gains they're offsetting that loss carry forward against those gains. So
Yeah.
we'll look at the. In fact, let's use this as an excuse to kind of get into looking at these rates. Let me minimize this a little bit. So I think it's important that people understand that the difference between the regular tax rates and the capital gains tax rates. And so what we're looking at here is a simple chart that shows the three brackets on the top row. 0%, you can actually pay 0% capital gains tax on some gains, right? A lot of times people don't know that, but then there's the 15% and 20%, and there's an additional, 3.8% investment tax that you pay, but you've got to really be earning high levels of income to get to that. So today we'll just keep it simple, but let's just kind of look at the married filing jointly here and explain to us what this is saying, up to 78,750. What is that talking about there to get a 0% rate?
Total income for the year is below that figure, then you'd be paying 0% on your capital gains, but that includes what your capital gains are included in there. So let's say your other income was 40,000. Well, you'd be able to have 38,750 worth of let's say long-term capital gains, and still pay 0% on those capital gains.
Yeah, that's one of those proactive things that we look for. We try to. Because gosh, if you can sell something and pay zero tax on it, when normally in a higher year you might pay tax on it, why not do it, right? And sure. So that's one option. Now, once you get over, in this, staying with the married filing jointly, once you get over 78,750, then you get up into the next bracket, and this is a big bracket. I mean, that's over a $400,000 run. You can have an income and still be at 15%.
That's correct. Yeah.
So I guess going back to that 1099, when we were looking at those qualified dividends, that kind of really, to me, explains the real benefit of trying to invest. If you're going to invest in dividend owning assets, there's a real tax premium or savings if you can get them to be qualified dividends. Because if we look for a second over at the regular tax bracket rates, somebody, let's say that, they're up at around 300,000 of household income, they're in a 32% bracket.
Yeah.
For ordinary dividends, they would pay that 32%, right?
Yes, for ordinary, yeah.
But for qualified, that 300,000 still falls into this 15% rate. So it's half the tax rate.
Yeah, it's quite a savings.
Yeah, that's a big savings. Okay. Well, and then to get to the 20% rate, I mean, you've got to really be blessed and doing well, right? And I mean, people do get there, but that can be a real factor in cases where a lot of times people will have single years where they have a big spike in their income. We see maybe it's right in the year they retire, some stock options mature, or they get a big distribution from a bonus plan or a deferred compensation plan. And in those years in particular, there's just a real premium on going in and looking at this tax planning as proactively as possible, rather than getting to April 15th, turning everything in and saying, hey, is there anything I can do to lower my taxes? Right?
Always. Yeah. It's very important to notify, your tax preparer or your financial planner, advisor, when you have some kind of a windfall in the year, as early as possible. That way we can do some planning and still have time. April 15th, it's too late. It's too late by then.
It's too late. Yeah, too late. I made note here of a couple of exceptions or gotchas. Talking about capital gains in particular, are you still seeing the capital gains chart, or are you seeing the regular chart?
I'm seeing the capital gains chart currently.
Okay. So let's talk a little bit about something people run into all the time, and that's when they sell their house. How is a house treated? Because everybody's always worried they're going to pay tax on the sale of their house. Generally speaking, how does that work?
We see it a lot. We always see people concerned about that, and we tell them as long as it's your personal residence, you've lived there for 2 out of the last 5 years, and you haven't excluded gain on another residence sale within 2 years, then up to $250,000 of the gain from the transaction if you're single, or up to $500,000 of the gain if you're married, can be excluded from your as taxable income. So you get to exclude all that gain.
And so people, once they understand that, one of the first things they start thinking about is how do I determine the gain in the house? And let's say they've owned it for 20 years. Well, I guess,
it's hard.
Yeah, you go back and you know what you paid for it. You usually can figure that out, but then you might have remodeled it, or you might have done a pool or added an expensive fence or landscape upgrades or whatever. And I've never known for sure what can be added, extensively. I've never seen a master list, but generally speaking, most of those kinds of home improvements or repairs can be added in, right, over the years if you can go back and document it.
That's correct. And it's always good to keep a file. Keep a file that includes the closing statement from when you purchase the house. And then every time you spend money to improve it, or repair the roof, put in some new AC units, things like that, just keep it in the file. And when you'll never know when it comes in handy, because it might get you just right below that threshold, and you won't pay any tax on the sale of your home.
Another gotcha, I alluded to it earlier, is this 3.8% investment surtax. I think the rate, I think you get into that at 200,000 for a single filer and 250 for a joint filer, I believe. Explain how that relates to this capital gains rate and anything else. I mean, just kind of explain to us how that would work.
You're talking about the net investment income surtax?
Yeah.
So like I said, income over 200 for single, income over for income 250 above for a married household, you'll run into the net investment income tax of 3.8%. So it's possible you'll pay that when you're at the 20% rate.
So the example I was using earlier then of somebody in the 300,000 range, where it shows they would be at 15%, would they really be at an 18.8% in that example?
That's correct, yeah.
Okay, that's an important detail. So really your capital gains rate, if it was maxed out with that surtax on top, would be the 20 plus the 3.8%.
23.8, yeah, 23.8.
And I know
which is still probably, once you're at that income level, lower than your ordinary rate. So you're still seeing an advantage. It's just smaller.
Okay. And then another thing, I really don't hardly ever see this, but there are some exceptions to the normal capital gains rate, as I understand it: precious metals, artwork, collectibles, that kind of thing. Coins and precious metals are probably the more common things that people might sell. Isn't there a different tax rate applied to those, I think, than the regular cap gains rates?
Yeah, no, it's a 28%, and it's rare. We don't see it very often when people are selling these kind of assets. They usually are heirlooms that people hold on to.
So, I didn't warn you about asking this question in advance. Maybe you know, maybe you don't. But when we have markets like we have right now, people are tending to own and trade more silver and gold and things like that. Would that 28% rate only, would they still kind of have to own it for longer than a year to get the benefit of that? Do you know? And if they take on, yeah, I don't know. I don't even know. I've never run across that, but I also was thinking as we were talking about that exception, if they had a loss, because a lot of times, unfortunately, people zig when they should zag when it comes to trying to guess what the market's going to do. And it's the same in precious metals. Have you ever noticed, by the way, Jeff, that the commercials for gold and silver just skyrocket whenever the market's going nutso? It's amazing, isn't it?
Yeah, it's pretty high right now is what I've read recently.
Yeah. Whoever knew all these actors were such experts in precious metal investing. All right. Well, look, we bounced around a lot, but going back to the 1099, I mean, I just, I scrolled through here and you've just got on a 22-page document here. I mean, to the average person, this is going to be very confusing. And in this case, this is maybe a more complicated one than a lot of people have because there's a lot of trading going on here. There's some options trading. There's some different things going on. But the great news for you out there who are watching this is, you don't have to know all this stuff. You just have to know people who do know it all. And Jeff, I'm going to give you here as we wrap it up. We've got another couple of minutes, just one more chance to tell people if they're interested in finding a good local CPA in Georgetown. We actually happen to be neighbors in the same building, so we see each other all the time. But tell them one more time the best way to reach you, and then we'll wrap it up.
Sure. You can call the office directly. The phone number is 512-863-9544. You can also email me at jeff@georgetowntax.com.
jeff@georgetowntax.com.
That's correct.
All right. Well, look, thank you so much. We'll have to do this again sometime and find a topic that is not quite as stimulating as the 199A deduction maybe, but I always appreciate your time and expertise, Jeff, and stay safe and have a great day. We'll see you.
Thanks for having me.
See you, everybody. Bye-bye.